how does the 70-30 work?
We're drinking bourbon and now you're really getting, okay, hang on a sec. What they do is they say, hey, how can I learn more?
Right.
How can I get
That's
on
the
your
key.
list?
That's what you want to hear. I have two really quick questions. So with raising capital, do you do 503B or 503B or C's?
506B, 506C.
Oh, 506.
Yep,
Okay.
yep.
That's close.
Yeah, we do both.
Close
enough.
Count it.
We do both.
You do both?
Yep.
Okay. So one, you have to be registered with the SEC, and the other, explain
in
that.
either case, so you're registering the deal with the SEC attorney, essentially. You're registering the deal. It depends on the exemption that you're going for. So you're basically saying, we're going to bring this to market as a 506B or a 506C. And if we're choosing to go to market as a 506C, basically what that means is the investors, those who write us checks to go in the deal with us, have to be accredited. And what that means is they have to have made $200,000 per year for the last 2 years and expect to earn the same in the current year. So 3 years of earning $200K. Or it's not it's or your personal net worth is 1 million or more, and that can't include the value of your personal residence, so outside of the equity you have in your own personal home. There's a flip side to that. So if you're married, your household income has to be over 300,000. So it wouldn't be 400. You're not doubling the 200. So over 300K for the last 2 years and in the current year. And I forget the equity requirement might still actually be at 1 million. So it's, by today's standards, it's actually quite easy. I mean, with inflation, folks are making a lot more money.
What's the benefit of going 506B versus 506C?
So the benefit to us is advertising, basically, if I were really going to simplify it. So if we're, when you have to raise 2 million, that can take work. When you have to raise 10, 15 million on bigger deals, that takes a lot of work. And if you're registered as a 506B, like I couldn't go on Facebook and say, hey, we have this great deal. We're offering these returns. You want to invest? I just broke the law. I can literally go to jail. I have to rely on my own Rolodex, my personal contacts, friends and family. So with a 506D, you're basically raising from friends and family or people that you know in your network that you have a direct relationship with, but you can't broadcast it in public. With a 506C, I could take out a billboard on the side of a highway if I wanted to. It's all fair game in terms of how we make people aware of it. But at the end of the day, we have to make sure anybody who writes us a check, we have to go through a process and show we validated they're in fact accredited.
So with the friends, family, acquaintances, is there not a requirement in that as well? Like you have to have known them for a certain period?
They call it a pre-existing relationship, and it's very fuzzy. There's not a lot of real good guidance. If you talk to 2 different SEC attorneys, you get 2 different answers. How many conversations does it take? Blah, 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 right? And generally, to be safe, I'll tell you what most people do. And I'll tell you what I do. I hold a lot of events where I just talk about the power of alternative investments and private equity. That's essentially what we are. And we just have a deep specialization in multifamily real estate. And I talk about how it's sort of untethered to the stock market. And so there's a lot of folks that come to us that have this risk that I'm all in on my 401k or everything I have is in the stock market. And I know from watching the Great Recession, right? Some people were forced back in the workforce another decade. Like, I don't want that to be me. I'm 5 years away from retirement or 10 years away. Like, I know I should be investing differently or more aggressively. And I educate them on the tools and the assets to do that, real estate being one of them. And so all I'm doing is educating them on the other types of investment vehicles that are out there. And I'm not selling anything. I'm not pushing anything. And as long as I don't mention a specific deal that we have, that's good enough. And what they do is they say, hey, how can I learn more?
Right.
How can I get on your list?
That's the key. That's what you want to hear.
So I've satisfied one objective, because one of the things you have to do to make sure is, like, you have to take the time to educate them on the benefits of the benefits and the risks. The SEC, what they're trying to avoid is people just pushing these really, attractive opportunities, like, hey, you can make 20% returns, blah, 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 come invest. It's super easy. Well, without ever talking about the risks. Now you've got uneducated consumers going in and risking their life savings. That's what they're trying to avoid, and with good reason. So, but now we've started the relationship, we've started the education process, and I'll say to them, let's have a follow-up call. I want to learn more about you and your personal financial position. We have to talk more about your specific goals. So even still, I'm not talking about a deal. I'm taking time to get to know them and see if it'll be a real fit. Now I've had 2 conversations, and by most standards, we have a pre-existing relationship. That's good. I've taken the time to explain everything.
That makes sense. Yep. So for all the listeners out there, if, if they, if they're deciding, well, is passive for me, is active for me. Let's say owning, so we own property, and I'd say it's pretty active. Like we're in it every day.
Yep.
We answer, deal with tenants, deal with property managers, deal with lawyers. We're in it every day. As of someone as an LP in a syndication, they're truly passive. They hear from you once a quarter, maybe once a month, whatever. Are there any benefits? Are there any more benefits to actually owning a 2, 3, 4 unit by yourself versus being an LP in a deal, whether it's tax benefits? So it sounds like you get similar tax benefits, whether it's depreciation, and the write-offs and stuff. But like, why wouldn't everyone, ourselves included, just be LPs in a deal versus owning your own real estate?
Two things. Education and access. Folks just aren't even aware that that's an option, and then they don't have access to somebody like me who can open that door for them. I think. But
are we getting the same? So we enjoy all of the benefits of owning real estate.
Yeah.
Is there any benefits that you don't get as an LP that we get now?
That you get now on the operator side?
No. So if I'm just an LP in a deal, do I get all the same benefits if I just owned it by myself? There was no syndication. I just owned a 4-unit.
They are part owners in equity if that's how it's structured, right? So in theory, like you would get the same, if I'm correct.
I think
other than 100% equity if you own it by yourself. Right. Is there any other thing I'm missing?
No, I mean that's the lure of being a passive investor. That's why doctors, attorneys, and high net worth investors like it so much, because they don't have time, right, to go and learn and deal with all the risks and all the things that we go through as landlords, right?
But that's my point. There should be we should be enjoying some, because we go through everything. We deal with it all. We should be enjoying more fruits of our labor than just, hey, here's, sell our entire portfolio. Here's $3 million. Go invest it. And I trust you. Obviously, we trust ourselves with our money, but I'm just thinking. So
that's what I was. You kind of brought it up there. Yeah. This might not be a monetary thing, but for us, we have 100% control. So if we mess up, it's on us. If we succeed, it's on us. Kris is a great operator, no doubt. But if, let's just say we sold our portfolio and didn't invest with Kris and invest with somebody else, we're sort of if they mess up, it's what do we do?
It's letting go.
We make a bunch of phone calls hey, what do you do? We don't have that same level of control. So we're sort of beholden to them.
The only way you would have control is if it was a JV essentially. And so now you have decision right. It all comes down to the operating agreement. But you're handing control over to somebody that you trust. Yeah,
but even as an LP, so correct me if I'm wrong, but they would have it under 19 or 20% equity in a deal.
Okay, so yes and no. So what you're bringing up there, because
they're not on the loan doc.
Banks, and it depends on the bank, but a lot of banks will say no single limited partner investor can own more than 19% of the overall deal. If they do, it's okay. They have to go on the loan aside next to our names as
full underwriting. Essentially.
They basically
guarantors.
Have to sponsor. They're a guarantor of the loan. Yep.
And no LP really wants that responsibility.
No LP really wants that. Yeah.
That's fine.
When you're doing a small deal, a small being $1.5 million, $2 million raise, we've bumped up against that. Whereas I've said to some LPs we're gonna have to cut your investment down a little bit. You're gonna have to go in the loan. When you're raising $15 million, it's not often you're going to get a single guy who's going to write a check that big.
Follow-up question.
Yeah.
This is easy, at least for me, to think about getting people's equity back, investors' equity back on a sale of a property. If let's just say the market's really rocking and rolling and wow, this thing is really appreciated. I can actually refi, keep these people in the deal. How does that look like for investors that have equity? Are they keep their same equity, same interest, or what changes on a refi?
Yep. The way that we structure our deals, they keep the same equity going forward. What a lot of people are doing now, they're basically saying when we refinance and return your capital, it's going to a 50-50 split. And just for the listeners, typically a syndication set up where it's 70-30. 70% of the equity in the deal goes to investors. They're getting the lion's share of everything. That's one of the reasons why it's a great investment. And 30% is going to the operators, the management team, which would be us. And the way syndicators nowadays are setting it up is they say, hey, when we successfully return your money, we've essentially achieved a milestone. We deserve to be rewarded. That split goes to 50-50. And that's okay. Your capital's been returned. And so now everything you earned there for it is essentially an infinite return on your money. But we hold it at 70-30. We think our investors should continue to benefit going forward as they have prior to the refi.
So question here. So you just mentioned 70-30 split. So I'm just going to very simple numbers. Let's just say you're raising $1 million and you have someone giving $100,000 of this million that you need. They're not getting 10% or like what, how does the 70-30 work?
We're drinking bourbon and now you're really getting, okay, hang on a sec. It's the percentage of the overall equity being raised. What percent of, you mentioned $1 million, right? Mm-hmm. What percent of the million? So it's 10%, but 70% of the deal is allocated to that million. So it's essentially 10% of the 70%.
Yeah.
Right.
Yeah.
Yes. Okay.
You're testing me. I'm not a mathematician, but yes.
It makes sense.
We have models that tell me. I look at it and I go, okay, they're getting this much.
Yeah. Someone a lot smarter than us wrote that model.
So our biggest deal, and I know you remember this. I remember taking my lunch breaks in my truck and sitting on the phone with this person. I can't remember his name, but we paid someone a decent amount of money to run models like this. And I remember going through these splits when we were raising money. Yeah. Ultimately, it was better for us to just raise it from one investor and give them an interest rate. But I remember going through these splits, and it's confusing. But
and then waterfalls could come into play. Yeah, and that's a whole nother animal.
I guess bottom line is there's a lot of really fancy computer programs, so you don't feel like you need to memorize all this. There's people that can assist and programs that can assist.
That makes sense. Thank you so much for listening to Sky's the Limit podcast. We're always releasing new content, so if there's something you want to hear, be sure to comment below. And don't forget, subscribe to our YouTube channel. And just remember, sky's the limit, dive deep, and invest in how you want to live.